So Karen, some of members of the regulatory audience may be relatively new to the topic of catastrophe modeling. So to begin our conversation, would you mind just providing an overview of just what cat modeling is?
Well, first of all, as most people know, maybe not everyone, it's really a global technology now used by insurers and reinsurers around the world. And the focus of the models is to incorporate all the science on catastrophic events like hurricanes and earthquakes, tornadoes, bring it together with the engineering aspects of the type of damage that these events cause, and then ultimately, of course, provide the financial consequences to insurance companies. And what's really important about the models is it provides companies with the probabilities of losses of different sizes. This is what was unique about the technology when it was first invented so many years ago, because, you know, if I tell you, oh, if a hurricane hits Miami, the loss is going to be $200 billion, that's interesting information. But if I tell you it's a 1 in a 100-year loss versus a 1 in a 1,000-year loss, that will probably impact your decision making. So it's really important the models provide these probabilities of losses of different sizes.
So what are some of the ways in which catastrophe modeling can be used?
Well, Jim, there are a lot of applications of CAT models, and probably one of the primary ones is, of course, pricing the risk and estimating what is the risk-adjusted price. There's a famous underwriter saying that there's no such thing as a bad risk, there's just a bad price. And so in order to underwrite properties that are exposed to catastrophes, insurers need to know what is the right price. So that's a very important use, but also managing the large loss potential. As I mentioned, the catastrophe models will tell you, how likely you are as an insured to have a $1 billion loss or perhaps a $2 billion loss, depending on your size. And you need that information, and of course the probabilities of that, so that you can decide how much reinsurance you need to purchase. Or you could determine that you're overly exposed in one area and you need to cut back some of your writings in one area and maybe move your writings into another. So they're really important for managing the risk, transferring risk. You couldn't do a catastrophe bond transaction without running a catastrophe model. Investors want to know what is the pricing metrics for the bond. So there are many applications, and really any insurer writing property business these days should be embracing the models, because it's well beyond hurricane and earthquakes today. We have seen recently $8 billion derecho, $18 billion Arctic air outbreak. We just recently, KCC estimated $5.5 billion severe convective storm outbreak. So it's really the weather, really think about the weather and the impacts that weather is causing to insurers is also encompassed by the models.
We actually had here today some smoke from a wildfire in Canada that we've been dealing with. So can you tell me how catastrophe modeling might be used to address this existential risk like climate change?
First, let me just address the frequency perils, because that's a really important area, and it's really what's caused a lot of the current disruption in the reinsurance market is the lack of credible information on perils like wildfires and winter storms and severe convective storms. So it's really important. These are really the drivers now of an insurer's average annual losses and lower return period losses, such as the 5 and 10 and 20-year losses. And this is where we're seeing the biggest impacts. Now, you asked about climate change, and obviously this is a very important area, and it's also an area that the models are very valuable tools for quantifying the impacts of climate change on extreme events or weather events, such as hurricanes, wildfires, floods. So as a modeling company, we embrace all of the science that's being conducted around the world, all of the scientific research, and we bring that into bear into our models to figure out how increasing temperatures, for example, are influencing influencing hurricane activity, how increasing temperatures are influencing wildfire activity. So again, once we can quantify that, we can bring that into an insurer's decision-making process, into the prices, into their management of their exposure accumulations to see areas that may be increasing in hazard in the future versus not. The other area that we're working on at KCC is providing projected views of what the risk could be in future years, say 2025, 2030, and 2050. As you know, insurance, most policies are annual, so it's most important that we get what is the risk today, but regulators and other entities would like to see insurers taking a more future view of what could be happening 5, 10, 20 years in the future. So that's the other area that we're working on, is bringing together again all the scientific research on climate change and its impacts, and building fully stochastic climate condition catalogs that insurers can use to estimate how their loss potential is going to change in the future due to climate impacts.
How do you see CAT modeling changing as we move forward?
Well, the way I see it, it's expanding beyond what the insurance industry thinks of catastrophes. In fact, there's kind of an arbitrary definition of what is a catastrophe, but it's going beyond that and really building models that can capture daily weather. Because insurers, they have to pay claims from all the hail, all the tornadoes, all the severe wind, whether or not it's defined as a catastrophe. So I really see the modeling industry as expanding in not just to catastrophes, but to include all weather-related perils, and also to incorporate all the impacts of climate change on those perils. And of course, to do that, we are always advancing the science, and at KCC we've implemented very advanced scientific techniques on called numerical weather prediction, where we're going well beyond just extrapolating from the historical events into actually simulating real events as they unfold, like you see on the Weather Channel. We're using all the weather models and the radar and the satellite data. So we used to think of catastrophes, hurricanes, earthquakes, low frequency, high severity events, but our modeling technology has expanded well beyond what people normally think of as catastrophes.
Is it fair to say that catastrophe modeling could be used as a risk management and risk resilience tool?
That's a great question, Jim, and it's a very important one, because that is a very important use of a catastrophe model, which is quantifying the benefits of mitigation activities. And this is for all perils: hurricanes, wildfires, earthquakes. So the models are very good. Again, they have a very detailed vulnerability component where we have a lot of engineering knowledge. We've utilized a lot of actual claims data to be able to quantify if homeowners or commercial property owners engage in certain mitigation activities, what benefits they will receive in terms of reducing the vulnerability of their homes. But of course, that has wider consequences to society. And we're doing a lot to try to mitigate temperature increases in the future. But along with that, we really have to look at these different mitigation activities and mitigation devices. And as I said, that's a very good use of the model to be able to quantify the benefits and to be able to give discounts to policyholders, based on proactive measures they take to reduce the vulnerability of their properties.
How do you see catastrophe modeling increasing the capacity for insurance?
Given all the challenges we have today with climate change, demographics, some of the challenges seem insurmountable. But of course, those challenges look like opportunities to forward-thinking, innovative companies who are looking forward to embracing advanced models and advanced technology that they can have confidence in, that give them a good picture of what the risk is today, taking into account climate change, taking into account all of the weather-related perils, and then capitalizing on the opportunities in the market. So where some companies might see big challenges, other companies see opportunities, but they need the advanced models and the advanced technology to be able to capitalize on those opportunities and to feel confident that they are pricing the risk correctly, that they are managing the risk, that they are managing exposure concentrations. And with this, very sophisticated toolkit, then they are able to embrace those opportunities. And of course, that has many benefits for society because it really gives then more innovative products for homeowners and commercial property owners. I mean, that's what we want to see. With challenges, we want more innovation. And actually, we are working with very forward-thinking companies now on new types of risk transfer products that are based on, instead of indemnity loss, based on the KCC modeled loss. And the reason that can bring more capacity to the market, it's not to replace the indemnity cover, but to add to it. And the reason it can bring more capacity is because one of the challenges with major events is development time. Okay, it could take a year or two for an insurer to know what their ultimate losses are. And even PCS, it can take them 2 years to know what an industry loss is. So even if you're doing an ILW, it can take years. And what happens is investors, capital providers, capacity providers, their capital gets locked and trapped and for years, and they don't like that. So these innovative transactions we're working on, called the modeled loss, let the transaction settle within weeks versus months or years, and it's very attractive to capacity providers. So again, this is just one example of an innovation that comes from new challenges.
So where do you see the public policy landscape related to catastrophe modeling going?
There is some confusion in the general public now, the difference between, say, a climate model and a catastrophe model. And the climate models do provide important information, but they can't solve the problems on their own because they're pretty much focused on kind of long-run projections of just a few variables and at relatively low resolution. But as a catastrophe modeler, we embrace the output of the climate models, and we can build that into the catastrophe models so that policymakers, as you said, beyond the insurance industry, will have a better view and a quantification. Just like insurance companies need, so do policymakers need to know what are the financial implications of climate change. Where are those implications going to be worse? What geography? Which locations are going to be the most impacted by sea level rise? But more than just the sea level rise itself, what it means for the built environment. And that's what the catastrophe models contain, as well as the science. How is the built environment going to respond to these perils in the future? And again, just like we say insurers, that no such thing as a bad risk, just a bad price. The same thing with regulators that and policymakers, just understanding and getting a good quantification of the risk is kind of the start of making policy. Before you understand what the risk is, what the financial implications are, you can't really make effective policy. So you need those models to give you the appropriate quantification, and then you'll have a good foundation for weighing different alternatives. And just like insurance companies can use the models for testing different mitigation strategies, policymakers can use the models to investigate different resiliency strategies. Where do we might want to relocate people? Where do we not have to do that? We can just enforce stronger building codes or make that. So all of this rich information can be quantified by the models for really the good of society.
So climate change models are actually looking at how climate change is affecting exposures, but catastrophe models are actually looking at climate change and also how people are moving and businesses are moving into catastrophe-prone areas.
So what are the implications of those climate changes to the built environment?
So Karen, how do you see, programs like this, where we have the Insurance Regulators Education Foundation here at Katy, working in collaboration with Griffith, helping to inform on this particular issue?
I was so happy that you invited me to be part of the conference this year, and I was very happy to attend and hear some of the questions and just engage with the regulators. I think it's a great forum, and I thank you again for having me as part of it.
Thank you for spending your time with us.